Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, March 13th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to see the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro event is the fiscal goose remains loose. So the nuance there is both Donald Trump and Joe Biden secured their party's nomination for president, ensuring the least anticipated rematch of all time. Back in the fall of 2020, I was urging investors to get long that reflation bull market because the difference between the two candidates was negligible when it came to blowing massive holes in the federal budget deficit. We expect U.S. fiscal policy to remain sustainably loose over both the short term and long term in terms of market implications. With respect to the short term, we continue to anticipate the fiscal impulse will remain positive in a general election year, a view that was supported by yesterday's February federal budget report. The positive fiscal impulse favors the no landing scenario above all others and is a contributor to why we think the current risk on Goldilocks market regime will likely transition to risk on reflation before ultimately settling into risk off inflation later in the year. Refer to our February 24th and March 2nd around the horn presentations for more details. With respect to the long term, we are keen to refer investors to our deep dive empirical study on turning growth, inflation policy, and market dynamics for more details. That analysis is likely to be found in the appendix of our macro scouting reports for the next decade plus. Transitioning to our 42 macro dashboard here. So as always, we'll start with a review of the trading range signals from our friends over at Longbow. Not getting any overbought or oversold signals. So we'll keep it moving here, and we'll wrap up with a question from our community. The title is Coupon Supply. So hi, Darius. Thanks for all that you do. Please, could you elaborate on the magnitude of the upcoming coupon supply in the context with your views on the Immaculate disinflation theme for at least the second quarter of 2024 and what this means for government bond yields? What are your views on a potential reduction in QT heading into the FOMC meeting? So those really two questions there. In the context of coupon supply, we know that coupon supply has been trending very, very light on a net financing base in terms of net treasury net financing on a trailing 12-month basis. Coupon supply is projected to increase in the second quarter of this year, and net bill financing is projected to decline pretty substantially to an outright negative number on a net financing basis. If you look at coupon, that increase in coupon supply at the margins is less favorable from a U.S. liquidity perspective than it has been in recent months and recent quarters. But the reality is it's not as unfavorable as it might seem on a headline basis. There are some very favorable bond supply dynamics that are supporting that. So if you want to see that analysis, we do a deep dive on U.S. and global liquidity every month in our monthly macro scouting reports, specifically with respect to U.S. Treasury financing schemes. You can find that analysis on slide 51 through 56 of the most recent monthly macro scouting report. We published that last Friday. And then with respect to Immaculate disinflation, Immaculate disinflation, we expect to persist into the second half of 2024. Our econometric models have inflation bottoming at a politically unpalatable level sometime in Q3 before and starting to reaccelerate in Q4. Who's to say when the market's going to really sniff that out? But it's our expectation that we could carry this risk on market regime into at least mid-year, if not longer, just based on some of the drivers of Immaculate disinflation, which we flesh out on slides 31 and 32, 34 and 35, 40 and 46 in that most recent monthly macro scouting report. And then with respect to QT, so that's a separate topic from my perspective. So just addressing QT. So let me start by saying the Fed is not doing quantitative tightening. They have not engaged in any act of quantitative tightening, to my knowledge, in the history of the Federal Reserve. Quantitative tightening is when you sell bonds to the market to tighten monetary policy. They are not selling bonds into the market. Recall that when they did quantitative easing, they were buying bonds to the market and replacing them with zero duration assets, i.e. bank reserves, which obviously got levered up and or funged around the financial sector into the various forms and risks and transferred into various risks. They're not doing the exact opposite of that. What they're doing, what we've been calling is balance sheet roll-off. Here at 42 Macro for the better part of the last few quarters, which is, balance sheet roll-off is just allowing what used to be a bond that has since, matured over time and became a zero duration asset that ultimately decays and rolls off the Fed's balance sheet. And instead of reinvesting that principal repayment into a a bond, sort of a longer duration asset like another bond, what the Fed is just doing is allowing those zero duration assets to go back into their to the they're just allowing those zero duration assets to kind of evaporate from their balance sheet. So what that ultimately means is that the Treasury, which is used to the Fed reinvesting that money into longer duration assets, they are not getting that tailwind from a net financing perspective because the Fed is allowing its balance sheet to roll off. So it is tightening monetary policy, but it is not quantitative tightening. And certainly quantitative tightening would be much more onerous from the perspective of asset markets. We wouldn't have a raging bull market in stocks and crypto and credit if we were actually experiencing quantitative tightening as investors. So it's our expectation, as we talked about on slide 71 in that macro scattering report, the most recent macro scattering report, that balance sheet roll off is likely to persist over the medium term and could go for much longer than most investors think. We are a long way away from the minimum level of reserves required based on our analysis for the U.S. financial sector. So, in our opinion, we don't think policymakers are too concerned about that. And more importantly, reading the tea leaves, it seems to be that the Bernanke doctrine, which means you have to use both levers, the balance sheet lever and the policy rate lever of monetary policy in the same direction, that seems to have died with the Jay Powell Fed, and Jay Powell seems to be totally fine with allowing balance sheet roll off to take place while they are lowering the policy rate, which is likely to occur sometime around mid-year, in our opinion. So we'll wrap it up there. Hopefully, if everyone wants to get a deeper dive on that, on those key takeaways, obviously hop into our most recent macro scouting report. Every month we put that out. It's around somewhere between 100 and 125-ish slides. We go through that in about 60 to 75 minutes every month, and it's basically chock full of all the analysis that you guys are spending countless hours trying to figure out by stringing Substacks together and tweets together and LinkedIn posts together and hours and hours and hours listening to bear porn podcasts. The reality is, if you just dedicate 60 to 75 minutes of your month, you'll know all this stuff with great detail and have a great forward-looking view into all these really critical macro policy and market dynamics. So thanks again for joining us. And by the way, at noon today, we're going to have our friend Dylan Leclerc back on our Pro to Pro live program. So definitely come check that out. Obviously one of the smartest people in the world in terms of the Bitcoin space, the crypto space. So super excited to have him back. And we're very much looking forward to his updated analysis on some of these crypto market dynamics, because clearly it's been one of the key news stories in our industry for the better part of 6 months or now. So we'll wrap it up there. Everyone have a great day. We'll catch you back here tomorrow. Cheers.